Hi, everyone. Welcome back to the Morris Financial Concept Podcast. I'm Richie Guerzon, and we're bringing back investment portfolio manager Bart Valley, and we're going to be talking about the recent banking crisis. Bart, how are you doing?
Doing great, Richie. It's good to be back with you.
So, given the recent crisis, can you tell us how it's really affected the broad market?
Yeah, well, probably not as much as the average investor would have thought a few weeks ago. The federal response has been strong, it's been purposeful, and it's been reassuring. So it seems like, as of the time we're talking today, that the worst of this is past, and a lot of the kind of upheaval with regional banks has settled down. Richie, I think I would say the interesting thing to keep an eye on going forward will be the various ways that these higher interest rates continue to affect things. You think about the federal funds rate, which is kind of the rate everybody mentions. We've
Mhm.
gone from basically 0% to almost 5% in 1 year. And so you
It's
don't
it's
raise.
it, it is very aggressive, right? I think I read it's the most aggressive it's ever been, even compared to the 80s. Is that
Well,
correct?
certainly, yeah, at least since the 80s. And it's the speed with which not only the magnitude of the rate increase, but the
Hmm.
speed. And you don't raise rates that much from such a low starting point without potentially a few things breaking along the way. And I think this banking crisis was just an example of one way that's played out.
So, what kind of things could we expect in the coming months? Do you think from raising these rates so aggressively?
Yeah, I mean, we can think about that from an economic standpoint or from an investor standpoint.
Uh,
Think about it from an economic standpoint. Look, I mean, remember the intent. Why did we raise these rates? The rate measures are meant to slow an economy that's run too hot. So it's the Fed's intentional steps to say, hey, things are running too hot. We got to slow that down. So slower growth. That's what we can expect, right? People talk about, will we hit a recession? Will we not? I don't think the semantics of that are as important, just to realize that we're going to see a period of slower growth economically. From an investment standpoint, look at it a couple of ways. First, if you're looking at it from the fixed income or bond standpoint, things are looking pretty good, right? We've got yield again. We had such low rates for many years. For bond investors, you were basically making nothing on that money for all intents and purposes. It was just a safety piece of your portfolio. But now we've got some yield back. I heard somebody say the other day that if you don't like bonds right now, you just don't like bonds.
uh,
Yeah. So fixed income, we're not in the business of prediction, but fixed income looks attractive, right, relative to where we've been the last several years. From an equity or stock standpoint, I think we'll continue to see some reactivity. Look, the when we talk about these rate increases, they have a lagged and a variable effect in the economy and through different industries and different sectors. So it's going to be interesting to see how that continues to play out. Again, the Fed has raised rates very sharply in a very short period of time.
how do you think the crisis might affect their policy moving forward?
Yeah, uh, great question, Richie. And I think we've already started to see some of that play out in earnest, right?
Mhm.
Remember, it's not the Fed's policy to hit some previously signaled rate target. It's their policy to tighten financial conditions enough so that we're slowing growth and ultimately slowing inflation. And so, if that's the policy, keep that in mind. The recent banking crisis is going to naturally cause money to tighten up in the economy. So, it's kind of done a little bit of the Fed's work for it.
Oh,
Um,
that's interesting. I hadn't thought of it from that perspective. It's actually helping to achieve that overall goal.
yeah, it's having the same effect, right? It's slow. It's likely going to slow growth in the economy. And in fact, we've already kind of seen that with the Fed's most recent meeting, which was on March 22nd. The Fed raised the federal funds rate by 0.25% or 25 basis points versus some of their previous 50 basis point increases. So a lower increase, and importantly, they always have language that they put out along with their rate decision. And in their
Mm.
language, they removed the word ongoing, from their language on rate increases. So we're likely to see at least one more rate increase to kind of get them where they want to be target wise. But
That's fairly significant. They didn't say ongoing. I mean,
yeah,
they've been
and
saying
so
that.
it's kind of taken that thought away that, hey, for the foreseeable future, rates are going to be going up and up and up. Um, you know, we might be closer than we thought given what's happened with the banks.
Okay. They're kind of peeling the Band-Aid off.
Yeah, yeah, I think that's the way you could put it, right?
All right. So how can investors kind of navigate this uncertainty right now?
Um, Richie, I would say to me, it's just a really important reminder that we have to accept uncertainty, and we have to plan for uncertainty. Uncertainty is a part of life, right? But we still make plans with our life. We know uncertainty's going to make going to make things a little different than we planned. Same thing with investing. We have to have a plan, but also realize that uncertainty is unavoidable. But if you have a well-structured plan, periods of uncertainty like this, they don't change anything. If you're proactive, we like to say with our clients, we want to be proactive versus reactive. So you can weather uncertainty like this just fine. I mean, one way to look at it, Richie, think about the last 3 years, right? Think about the last 3 years we've been through: a
Yeah.
global pandemic, Russian invasion of Ukraine, high and persistent inflation, fears of a recession. But if you want to talk about uncertainty, that's a lot of uncertainty, right?
Absolutely.
What has the market done over those 3 years? So I was just looking last week at a broad measure of the U.S. stock market index called the Russell 3000 index, and looking at their website for the past 3 years, the Russell 3000 index from February 28th of 2000 through February 28th of 2003. Let me get the number exactly right, was up on average 11.79% a year over those 3 years,
Okay.
those periods of uncertainty. And in fact, that's higher than its historical average.
I bet that would surprise a lot of people.
Yeah, I mean, it surprises even the professionals because we see there's been a lot of volatility in within that, right? But again, it kind of points to that long-term plan. We can weather the uncertainty. If you're looking at shorter term money, it shouldn't be invested in stocks. But for that longer term money, in funds that you have appropriately allocated to stocks, if you have a longer term plan, things like this shouldn't derail that plan. So we kind of look at it three ways: embrace uncertainty because it's going to be there. Don't try to time the markets because history has shown that that is futile. And diversification is your friend.
So can you talk about the importance of diversification in your portfolio, especially when times are really crazy and volatile like they are now?
Yeah. And I think the banking crisis that we saw and what happened with Silicon Valley Bank, and talk about that a little bit more in just a minute,
Yeah.
what kind of effect it had on indices. But it's just another reminder of how diversification works. Merton Miller, who's a Nobel winning economist, he often said diversification is your buddy. And I repeat that a lot to clients. So we can't diversify away all risk. There's certain risks that are just systemic. If you're going to be an investor, that you can avoid risk of something like a recession. But diversification can still be a really important tool for most clients in reducing risk that they might face, like the risk of a particular company underperforming or the risk of an industry or even a country underperforming. So I'll go back to Silicon Valley Bank, which was, that was the big failure. There
Yeah.
was three bank failures that happened kind of in succession, but Silicon Valley Bank being the one that we all heard about on the news. If you look at a broadly diversified global stock index, the one we often use is what's called the Morgan Stanley Capital International, or MSCI, All Country World Index. That's a lot of words there, but it's basically an index that tracks almost all of the publicly traded stocks around the world. So very broadly diversified. There's about 9,000 names in that index.
I hadn't heard of that, and now I'm going to look it up right
Yeah,
after.
the MSCI All Cap World Index, or ACWI. It's just it shows you broadly how stocks are doing all around the world, large companies,
Yes.
small companies. As of February 28th, Silicon Valley Bank, which was a member of that index, it only represented 0.03% of that index. So one company's a tiny part of that index.
Yes.
Regional banks as a whole represented just about 1% of that whole index. So
Regional banks as a whole in the United States, you're
no,
saying?
so regional banks all around the world, right? If you classify
Okay.
companies you classify as regional banks represented, and those are the ones hit hardest, certainly in the
Yes.
US, but had some international effects as well, represented about 1% of that index. So point to that being, if you're an investor that's broadly diversified and invested in an index like strategy that is investing all around the world, you're not meaningfully impacted when a single company like Silicon Valley Bank, your stock goes to zero. It doesn't meaningfully impact you as an investor if you're broadly diversified. So again, it's just the importance of that from a risk reduction standpoint.
So, if we look at the recent crisis, is there any historical examples that can offer us some insights on what maybe we should do?
Yeah, I mean, we'll think back, and I almost hesitate. Again, we're talking right now at one point in time. We'll see how this all continues to play out. I almost
Mhm.
hesitate to call this recent one a crisis, even though that's what we've all labeled it. But
That's
if you
true.
look relative to historical events, right, it seems kind of it seems kind of a lot to call this a crisis. So
Also,
just
maybe some hyperbole going on in the news.
yeah, I mean, we'll go with crisis for now, right? But a
Yeah.
small one. And you see, if you look back historically, I mean, let's go back to the Great Depression. That's probably the most notable historical example of banking crises, and we've all seen It's a Wonderful Life, right?
Mm,
And think about the scene there when Jimmy Stewart's George Bailey is going to the bank, right? He gets to the bank to go to work, and it's being mobbed by all the people. And I want my money, everybody. I want you. That's a classic example of a bank run, right? And so the Great Depression is a historical example. The savings and loan crisis in the late 1980s, which was a period where we also had some it was due kind of to interest rate policies and a little bit to deregulation as well. We don't need to get into all the details of that, but a very severe period in which over 1,000 savings and loans failed. So a
wow.
tremendous crisis there.
That's a crisis over
Yeah,
1,000.
absolutely.
Okay.
Thousands versus three.
Right.
And then we think back to 2007, 2008, which is probably the most relevant recent example, and one that a lot of current investors remember because we were a part of that. And that was quite a severe crisis as well. And so the one thing I would point out, Richie, one difference between now and what we saw in the last several weeks and what we saw in 2008, it was two different kinds of events. Okay, so the recent one was what we would call a liquidity event. And a liquidity event is when a bank has insufficient liquid assets on hand to cover immediate cash demands, right?
Yeah.
Versus what we saw in 2008, which was a solvency event, which is when a bank simply has insufficient assets to cover its debts.
Ah.
A lot more severe of an issue. So again, it's not to minimize this current issue, but it's a little bit different than what we saw in 2008, and that's one thing we like to point out to our clients. So, every one of these situations is different. And another thing, hopefully, each time we go through a banking crisis, we learn something. We put plans and safeguards in place to make the next one less severe.
So, how do you think the current crisis and its aftermath might affect different sectors in the economy? Are there certain industries that are going to be more resilient than other ones?
Yeah, I mean, as far as effects and resiliencies, it's notoriously difficult to kind of predict industry performance. We can go back and look historically to say, hey, during different phases in the business cycle, which sectors tend to do better. Again, a lot of that tends to get priced into the market because everybody knows that. So, one thing I would focus on is specifically within the banking, financial sector, and then more specifically in the banking industry. I think there's going to be some questions on, again, how do these higher rates continue to affect things? If you think about banks and the way they make profits, they tend to make money. So they tend to, so basically, if you look at banks are borrowing on the short end of the yield curve, and that's in the form of deposits, right? And then they're lending on the long end of the yield curve, and that's in the form of mortgages or buying treasury notes, whatever that may be. And in a normal yield curve environment, you've got lower rates on that short end and higher rates on that long end. So banks are borrowing at low cost and lending at high rates, which gives them a profit, right?
Mm-hmm.
And so with the rate increases we've seen over the past year, and the fact that for quite a while now we've seen what's called an inverted yield curve, which means that those short end rates are actually higher than those longer rates. And so you've got a lot of banks that are either buying or holding long-term assets at low interest rates, and they're increasingly having to compete by paying higher interest rates on those shorter term deposits. So it's kind of turned things on its head.
So do they effectively lose money the whole time you're in this?
They can, and I think that banks are going to have to continue to be very vigilant about. I think there's going to be some banking issues where we continue to see some mismatches between assets and liabilities from the bank standpoint. So banks are just going to have to be really vigilant that they're staying on top of potential liquidity demands. And then again, it's probably not the greatest environment for bank profits right now. Typically, higher rate environments are good, but as long as we have an inverted yield curve, and again, a lot of assets, longer term assets on the books of banks that are at lower rates, it'll be interesting.
So again, are you saying we currently have an inverted yield curve, or it's
we do. We have for quite some time now. And that's not all that unusual in this part of the business cycle. It's happened many times historically, but it's interesting in the way we've come from such low rates for such a long period. So again, as banks have been buying assets and holding those assets on their books, there's going to be some banks, and Silicon Valley Bank was an example, where when the yield curve wasn't inverted, it was a normal yield curve, but rates across the curve were really, really low. So you didn't get a lot for going out further on the yield curve, but you got a little bit higher yield. A lot of they were trying to, as we were as investors, some of us, we were trying to find yield wherever we could get it, right? And that's something we try to advise our clients against. It's not worth chasing yield, right? Let's think about why we have fixed income in the portfolio. Lots of reasons, not just yield. But some banks and some other investors kind of said, hey, I'd rather have 1% yield versus 0.1% yield. So I'm going to go out and buy 30-year bonds that are paying me at least a little bit of interest. Well, now you see where banks might be holding a 30-year bond on their books, and all of a sudden interest rates go from basically 0% on the short end to almost 5% on the short end. And all of a sudden that 30-year bond that's paying 1% isn't that attractive to folks anymore. And so that's why it goes down in price. And then if banks have to start unloading those bonds that they thought they were going to hold for 30 years, but they have to start selling them to meet liquidity demands, that's where a problem comes in. And that's what happened with Silicon Valley Bank.
And that's what happened with Silicon Valley, right?
Yeah, that was one of the dominoes that fell. And so I think banks are just going to have to stay on top of those liquidity demands, make sure they're accounting for them in a reasonable way. So yeah.
So are there any misconceptions about banking crises in general and how they affect the economy that you want to talk about?
Yeah, I mean, I guess you see a lot. I read a lot. I try to read as much as I can of the media every day, just to kind of see what's being said out there and what people are exposed to. And some of that's great information. Some of it's not as great. And some of it's just misinformation. So part of what we do is try to, help put an appropriate lens on that for our clients. So as far as bank crises, I would say, maybe some misconceptions. One would be that bank crises are all alike. They're not. As I mentioned, they're all different.
Yeah, insolvency versus liquidity problems sounds
Yeah,
very
yeah,
different to me.
you're exactly right, Richie. The second might be that bank crises are rare. They're not, and this is maybe surprising to some folks as well. If you look at FDIC data, there since 2001, I'll get this number correct here exactly. Since 2001, there's been 564 bank failures in the United States.
500.
Yeah, so it's a surprising number. Now, granted, most of those are small banks, not anywhere near the size of like a Silicon Valley Bank, which was the second largest failure we've seen historically. It was the 16th largest bank in the country in terms of assets at the time. So it was a big failure. But as far as numbers of failures, 564 since 2001. And think about it, banks are businesses just like any other business. Some are run well and some aren't, and so there's going to be some that don't succeed. And the third would be that bank crises are preventable. I think one of the things we rush to is how can we make sure this doesn't happen again. Pivot back to the point that all these are a little bit different. We can't necessarily prevent the next one, but mitigation is always important. So I think it's important that we have mitigation plans in place. And that's something we saw with that I think helped here with this recent situation is the federal response was really powerful and swift. And that helped to settle a lot of fears.
So tell me what a mitigation plan would be, for instance.
And so it's just thinking about, again, not necessarily can we figure out what in advance what might cause a banking crisis, but if it does happen, what are we prepared to do to stop the contagion, right? And so in 2008, that was one of the things we saw. And I don't think a lot of people realize in 2008 how close we came to a real financial collapse. There were some late night meetings amongst the big players, amongst the biggest banks and the federal government that came up with some solutions really on the fly that avoided a really, really severe problem. And so, again, it wasn't fun in 2008, but we came out of it just fine. So I think mitigation is putting steps in place that we have some potential plans that if a bank failure happens, that we know here's how we're going to address that. Here's what agencies might be involved. Here's what limits we're going to put on that. Here's how we might protect depositors. And here's how we might not protect the bank or the executives or the shareholders in that bank. That's what happened this time. Again, in 2008, there was a lot of criticism about bank bailouts and the government paying for, moral hazard. I think in this case, it was a little more direct and pointed approach in that the government stepped in and said, hey, we're going to make depositors whole, even though they might be above the FDIC insurance limits. We're still going to cover their losses because it wasn't their fault as depositors, but we're not going to help out the executives of the bank. We're not going to help out the people that held stock in the bank. So it's a more pointed approach. And so mitigation is just figuring out how do we address these problems.
I see. So how can investors prepare for these kind of future economic shocks that we just had, like a banking crisis?
Yeah, I think the most important thing, and you'll hear me repeat this, but just know that shocks will come.
Yes.
Yeah, and that's okay, right? If we can't know exactly what, we can't know exactly when. Again, the exact nature of the future is unknowable, but we can certainly know that surprises will come. I like to say that's every year. I can guarantee you one thing: there will be some surprises. That's one guarantee I can make as an investment manager. And I think another important part and corollary to that is avoiding hindsight bias. And this is something I think I've mentioned to you before, Richie.
Oh,
But
absolutely. Yeah.
we look at these cognitive biases that we all have as humans, and one that can affect us as investors is one called hindsight bias. And that's where we kind of look back at an event that was unpredictable. And then after the fact, and after we get more information, we kind of convince ourselves that it really was predictable. No, it wasn't, right? And so if you're talking about 2008, or if you're talking, a lot of times, we're going to have these surprises, and the hindsight bias that leads us to believe, oh, I should have seen that coming, or here's how I could have seen that coming. It can be dangerous because it can lead to overconfidence as an investor. It can also lead to emotional decision making. And one thing we know as investment professionals is that that emotional decision making tends to make for poor financial decision making. And so, again, that's part of what we do with our clients is helping them to avoid these various cognitive biases.
Well, that makes sense. I mean, it sounded like the answer really was more of a mindset shift that we need to have.
Yeah.
We don't make these emotional, rash decisions.
Yeah, absolutely. And again, being able to stick with a plan that was well thought out and rationally made, and avoiding that more emotional reactivity, which is hard to do lots of times. Absolutely.
So, do you see any long-term effects of this recent banking crisis? Is there anything the investors should do to change their long-term strategies?
Yeah, again, whether we're talking about a more severe financial crisis like 2008, or what we've seen so far, this time that hasn't appeared to be as severe, we seem to have avoided that contagion. Things have settled down. It's again just to expect the unexpected, and know that that's okay, right? It's hard when it's going on. And even back to this, think about, my sister-in-law was getting married the weekend that this all went down, so I wasn't watching the news daily. We kind of checked in on Sunday afternoon, and I was like, wow, there's a lot of stuff in the news here. And so, and
On a
by
Sunday,
Monday,
it's rare.
there was a fair bit of panic going on Monday within the markets, and certainly with the media. But again, avoiding that reactivity. Another thing I think that'll be important, coming out of this, is to think, if you think about a healthy functioning economy, it's going to be based on free markets, but also some level of reasonable regulation, and that's different for every sector and every industry, what that looks like. But this banking thing is an example. There's been lots of ebbs and flows of regulation and deregulation in the banking industry, through history, and it's kind of figuring out what works and what doesn't. And then it's politically tinged as well. But I think it'll be important for policymakers to come together coming out of these recent events, and that's industry executives as well as lawmakers, and to realize that these are complex problems and complex issues. And again, how can we have a healthy, functioning free market, but also have some appropriate regulations for protection? And that's a gray area, and it will take some nuance and some understanding and some compromise. And I hope we can do that politically. I trust that we still can. We'll see. But going back to investors, as we've said, this doesn't change anything as far as long-term plans. So expect surprises, realize that they're going to happen, and avoid reacting to what we might call the news of the day, because there's a lot of it out there.
That's fair.
Yeah.
Well, Bart, thanks for putting it all in perspective. I definitely learned a lot, and I'm looking forward to having you on the podcast again.
Absolutely. Thanks a lot, Richie.
You're welcome.